This mic is yours. I like
Perfect. Thank you.
the outfit.
Oh, thank you.
Not enough people nowadays wear a tie.
I had meetings all day, so
I like it.
I had to dress the part.
What's your name?
Stuart.
Stuart, you're going to have a minute to pitch. Are you ready to tell us what you're building?
Yeah, absolutely.
Without further ado, Stuart, what are you building?
Fantastic. We're solving a really big problem, which is home affordability. What we do at Cedar is we have a unique financing model that's effectively a new form of co-ownership, and we cut the price of houses for Americans and Canadians by 50 to 60%. Huge impact. Part of the problem why homes are so expensive this day is you're forced to buy a bundle. Two biggest components of that are the land and the house. Imagine if you went to McDonald's and you could only buy a Happy Meal. You wanted a burger? Too bad, you got to buy the fries, the milkshake, and a toy too. It's expensive. What we do is we unbundle that Happy Meal into its component parts. Cedar, we buy the land. You, the homeowner, buy the house. You remain in control. You can buy the land back from us at any point at a fixed formulaic rate. And essentially, you get to live in 100% of the house for 50% of the cost. We work with the existing mortgage ecosystem, so you can get a federal, Fannie, Freddie, FHA, or VA loan on the leasehold which you own. At the end of the day, you have title to the house. You can put in a pool, dig it up, renovate the house, whatever you want. We have title to the land.
Let's give you a round of applause. Well done. A very clear story. You want to finish that thought?
Yeah, no, I think I got it, yeah.
Super interesting. I'm going to start with some pitch feedback broadly. It's less about anything you did wrong, but more about some dynamics I think you're going to get in, kind of investors and VCs nowadays. Proptech is such an interesting category because it had highs and lows during, our decade of ZERP and, the phenomenon of, there's better and, 1,000 other stories. I think one of the things you'll want to do, and you started to do this, but I think, again, it'll be important for you to just do in general, is try to set up in a way that immediately drags people away from comparing you or worrying about those comparisons. And again, as we talk, I'm sure I'll probably say this. Sometimes I'll encourage you to come up with an analogy, and sometimes I'll tell you avoid analogy, because in your case, again, I think a lot of people feel like they've burned their hand on the stove. Because again, so many of these mortgage startups wound up not necessarily working out, not going public, having CEOs who called their employees dolphins. I don't know whether that was right or wrong, but that was the thing that happened. That was better, right? I wanted to say.
I'm not familiar with that, yeah.
Does anyone remember that story? Is that? Yeah, okay, good. I don't want to accuse the wrong CEO. Okay, that's just a thought. Let's dig in a little bit before I give more feedback. So you're basically turning the land into, I've never owned a home, so I'm not that familiar with these component parts. Feel free to edit how I use terminology here. But right now, I could kind of do this with other parts of my home. Maybe I go to, I don't remember the name of these startups, but they'll build out green power in my house and give me kind of like a home equity line sort of deal or a package.
Yeah, exactly. So those are all debt-based solutions. Usually they're secured with a second lien or a primary lien on your home.
Okay.
What we're doing is we're actually creating a brand new asset. So at the end of the day, you own the home, we own the land. There's two separate pieces of title. And you can then get a mortgage or a HELOC if you want
legal?
Exactly.
Okay.
Yeah.
Do people do the split now for any reason? As in, what arrangements exist where
so you
there's
find
one party,
leaseholds
one party?
all over the U.S. They're just not very common.
It's called leasehold.
Leaseholds, yeah, exactly. Examples are like federal land. So a lot of ski resorts, the Forest Service won't sell you the land, but they'll give you the right to use it for 99 years. You find pockets of this.
And the difference, by the way, in renting stuff on the land versus land itself is you have ultimate rights to do something on the land. Tell me the difference between
at the end of the day,
versus
it's about kind of the safety. And so our investor is able to give you 40 to 50% lower costs than a mortgage because they feel very safe owning the land and they have clear ownership of that.
What's the difference in them owning just the land and the property built on top of it?
So a similar thing would be, single family rentals.
Okay.
Problem with that, a lot of investors like it, but there's a lot of costs involved in managing a tenant relationship.
Okay.
You have to fix a toilet, leaky faucet, things like that. Here, the house is fully owned by the homeowner. And so there's no worries if they want to put in a pool or redo the kitchen, and we don't have to go.
100% rights to do whatever they want.
Exactly. As long as you don't start, mining for gold or drilling for oil or turn it into a gas station.
Residential use, commercial use.
Exactly. As long as they keep it resi or, whatever's permitted in that residential zoning for commercial, we're fine.
Does this exist anywhere?
Yeah, so you see it a lot in, the United Kingdom, in places like Singapore or Hong Kong, areas that have also run into the same problem we have where homes are just too expensive. And so again, we have to kind of think of a way to make it less expensive. And our solution is this leasehold as a service where we can help you unbundle the home. So you just buy the house component and you can buy the land back later.
Pitch feedback that is really interesting and unique to your business. not unique, but is particularly strong in your business. You create actually a lot of interesting parallel threads, and I'm not sure that's a good thing. Now, it's a good thing in the context of our conversation because I'm curious about this business. I'm paying attention to every thread. I want to unravel it with you to talk about it a little bit more because you have a few like very interesting thematic things going. It's the lease versus what's kind of the leasehold. It's the idea of splitting the property and the thing on. And the land. Is it land and property? Are those
okay. Land and house is a good way of thinking.
So that's an interesting one. Then it's the idea that this doesn't just create an interesting economic situation. It's the idea that it might decrease prices. Or, there's even economic theory about this. When you created that thread, I was like, oh, I have so many new questions.
Yeah.
None of them were related, though, to this first thread, because this first thread was like, does this exist? Is it legal? How much money could you make from doing this? What does the transaction look like? This one is like, oh, is this true?
Yeah.
And if it's true, that feels so impactful that I'm distracted by all the questions I have about whether or not it's true. You want to be a little bit tactical, and especially, again, thinking about the context of either talking to investors or people who aren't familiar with the space of like, when do you distract them with the idea that this will decrease the cost of home ownership? I do think a soft way you could still talk about this without, again, distracting is the word I'm going to use here, is to mention, hey, a potential buyer or a potential person who wants to be part of a leasehold and own the property right now faces home ownership prices that are getting unsustainable.
Yep.
And we're solving some of that. And then later you can say, and we think if we do enough of this, this will drive down home ownership prices, generally speaking.
Exactly.
But that theme thing, I think, save for later and just try to like maybe enclose it in the transaction for now so I don't get distracted by the politics at all. So okay, so in the UK, they've got this, bringing it here would decrease home prices. Let's talk about that for a second.
Yeah.
Is that true? So because you'd be splitting the asset.
Exactly. So there are other ways where people can try to do co-ownership models. Okay. Problem is you run into governance issues, right? We're trying to securitize the home. You own a fifth, I own a quarter. It gets crazy. Here, because we have a property ownership, a title-based solution versus a securities law solution, we solve that governance problem and allow us to have clear ownership and control of our portion of the bundle.
What does it do philosophically or, societally to split the ownership of land and property?
Yeah, fundamentally, again, part of the reason why homes are so expensive is this bundle has the land component, which is really an investment asset, and then it has the housing component, which is, a fundamental human need. And, when America was founded, that was very cheap. You could buy the bundle, no problem. Thing is, everyone needs a house. They don't necessarily need or want or can afford the investment asset. So you have people stuck buying their first home now at 38 across the United States because they can't afford to buy the whole bundle. With our product, where they can buy the housing component that they care about first and start to build some equity, they can get into that home 5, 6, 7 years earlier. And that means they're starting to build wealth, they're on the property ladder, and the government really puts the thumb on the scale with all the deductions you can take as a homeowner versus a renter.
Are those the same deductions you could take if you're in a leasehold?
Any lease that's longer than 30 years is treated the exact same as a regular piece of property you own for infinity.
Interesting. Is it good for us that we're going to split these? Like, is there a chance that land now becomes this like weird and powerful people only asset in a way that's worse than current home ownership issues?
Not really, because it's really just a form not of control, but of enabling you to buy the house and have clear ownership rights. And so really it's a solution.
But then we'll wind up being the classes of people, right? Like the wealthy will be the ones that own land and the middle class and lower class will own the homes.
And that's because you can buy the land back at any point. So at a fixed formulaic rate, you can buy the land back from us whenever you want. And that is a big difference between how it was done in the UK. In the UK, the Duke
When you say that, by the way, this is now bringing me back to your startup. So you own the land.
Yes, we own the land, correct.
So you are transacting and you're the one holding the leasehold.
Exactly, on behalf of endowments, pension funds, groups that want that long-term,
your operating company
safe
will
asset.
raise a bunch of special purpose vehicles.
Exactly,
You'll buy
Propco, yep.
What will be the relationship between when this is so important that I'm going to describe this for the YouTube crowd and the crowd here, because a lot of people don't know about how this can sometimes get hairy. And so I want to ask you this question of like, when you have a startup like this or a business like this, you have an operating company that's, what was your name? Stuart?
Cedar.
Cedar. No, your name.
Oh, Stuart, yes.
Okay, good. So he'll have two companies. It'll be the Cedar operating company. That'll be him as CEO, and it'll have the employees who work on the landing page and the forms and the AI he uses to fuel underwriting and all that stuff. Then he'll create over time special purpose vehicles and vintages of funds that he goes to endowments and other wealthy people and says, give me your money. We'll invest out of these vehicles. You'll be an investor in this vehicle in a batch or a vintage of potential properties, and that'll be a thing that an investor gets exposure to without needing to invest in the startup itself. And so the startup gets to basically create these special purpose vehicles over time, attract different investors, not to invest in the operating company, but in the fund, which also means because it's property, there's going to be more reliable metrics around returns and rate of return, et cetera.
Exactly. And so the investors in the land are getting about 12% net of our fees. Okay. Investors in us as a startup, we're hoping to do 10, 30, 40x here because we're building out unique technology that enables this leasehold as a service, the hookups to the registrar of deeds, the underlying legal technology, the automated valuation models to price the land separately from the house, the hookups to mortgage originators to make it nice and easy. That's the technology business. But to get that going, we also need to have this embedded investment management business to generate the demand for the land itself, which is a new and novel concept, but something that we've gotten a lot of really good feedback on.
Gives you a lot of real estate exposure.
Exactly.
Which is not necessarily a good thing.
Well, on the neat thing about our product fundamentally is it's a spread product. So it's a spread between different levels of risk. And we've back-tested this, and even in 2008, our product would still work. And so unlike a lot of other things in Proptech recently that really were just a function of a ZIRP environment, we're robust even back to the 80s.
So then talking about the relationship between you and your funds, are you going to be…
Yeah, so we're the general partner of the fund. Okay. And so when you're investing in our operating company, not only do you get the technology, you also fully own a piece of the general partnership and the asset
And the
management.
general partnership is the one executing decisions on deals?
Exactly, correct.
Do you know that that's not necessarily a good thing?
There's certainly a tax complication there.
It's not just a tax complication. So this is something, so this is startup slash pitch feedback, then I'll just do pitch feedback. Yeah. So you… when you are the one executing deals, you now have an incentive problem for your startup.
Yep.
So in these issues, in every startup like this that does Proptech investing deals with this in different ways. But basically, your operating company wants certain types of deals to happen because it packs the startup. How many deals can they get done? What can you put in the press? How do you change their technology? The fund just wants to return money to its investors.
Exactly.
When you are the one making choices here, the question will become, which priority do you have at any given moment? Do you have the priority of Cedar Operating Co. or of the investors from a real estate perspective?
Yeah. And it's the fiduciary responsibility we have to the investors. And so that is the most important thing.
Which thing?
The investors in the land. And we view by generating the deals and building a great asset management business, at the same time we're developing this enabling technology that allows this business to exist in the first place, we're going to generate returns for everyone.
You could underwrite poorly. I'm not saying you would, but you could underwrite poorly because you have a different incentive from the operating company.
Sure, right. People can always make bad business decisions that are short-term, accretive and long-term negative, but that's, not how you'd run a good business. And when you look at any asset management business that's enabled by technology, whether you're, a crypto business, a Proptech trading firm, or just even a traditional asset manager like BlackRock thinking of new ways to enable asset management via technology, you want to look at the core business. And for us, that's generating this new asset class. That's where the returns are coming from.
I'm going to, for the sake of time, just wrap some generalized feedback here. I'm not sure, and again, I'm not enough of an expert on this as not someone who's owned a home or invested in real estate. I'm not sure that's a good answer. So I know actually a lot of people who invested in a class of Proptech companies that had these sorts of relationships. And always the most interesting thing when I was talking to those CEOs or those angel investors in the early days was the conversation about how could they fix the incentive relationship between the operating company and all the funds and vintages and SPVs. In other words, that tension was so real that it was where they spent a lot of their brain power. They had answers to their investors as to, an example, I don't remember the name of the company, but it was a friend of mine was an angel investor, a different friend was CEO, and someone who became a friend ran the investment vehicles. And so he could make separate underwriting decisions without, other than their friendship, the pressure of the operating company.
Right.
And so they separated the underwriter and the fund, even though it was using the technology to your point and the principles and had a rule set imposed on it by the operating company, it was still and they still had an owner relationship, so the operating company still could benefit financially from the fund. The fund still made its deal by deal decisions in isolation of the operating company. I say that to say I'm not sure whether that's relevant here, but it feels so relevant. So I want to give you feedback of like, go figure that out, get a great answer, because investors who like this probably have done this before and will want you to have an evolved theory of, hey, how we're going to deal with this over time. And that brings me to overall pitch feedback. You are a good communicator. This is a super interesting idea. You've taught me a lot about leaseholds in this conversation. So you have a lot of check marks, but it's such a complicated new concept. There's so many dynamics. Your obligation, how far along are you?
So we're pretty far. We've launched in December, and we have about 65 deals now in the pipeline across the U.S. and Canada.
And is that off of operating co money, or you've raised a fund?
So both. So we have operating co money. That's essentially our general partnership co-invest. The opco owns the GP fully. And so that's the co-invest component. We put our money where our mouth is. And then we also have a fund component, mostly just family offices now, but we're in advanced conversations with insurance cos, endowments, et cetera.
Have you raised for the opco?
We've just done friends and family money, a couple million there.
So I think, your obligation to go to, again, other institutionals or angels who are professional angels will be, how do you package some of this story in a way that's so easy to consume? Now, they'll need to have more meetings with you. You will need to continue to educate them. So like your job is not to like fix it all at once. In fact, that would probably make a really bad pitch, but to give me a little bit more and a little bit of ease around some of these topics, so that because again, I think most people who will be excited about this will have to know something about it. Like if you find a generalist angel investor, I don't know that you're going to get a lot of those people excited unless they know someone else in the deal. Like you're just going to need to find people who've done these sorts of arrangements. And so give them more drive-bys of, here's some things we're dealing with across what will be our issues. So, we've set up this relationship with our funds where here's the dynamic, and here's what we've done with the leaseholds, and we're going to be the ones to own them, but through these funds, and here's how that's going to work. And a minute pitch, again, it's really challenging, but even in the context of either a minute or a first few minutes of a longer meeting, you got to make sure you don't lose them to the complexity.
Yep.
But super interesting business. Thank you so much for sharing.
Appreciate it. Thank you for having me.
Congrats on the progress, by the way.
Thanks.
Anyone have any questions for me about how I perceived that pitch? The feedback I gave, the storytelling there that they want to ask?
You mentioned you're an angel investor, right?
Yeah.
After hearing that, you're obviously pretty interested, but you're concerned about the legalities of it. And you actually mentioned a pretty good point where the fund and operating company puts this entire confusion, sort of a shit show. Still walking away from it, what would be your next steps in terms of deciding, yes, I would invest, or no, or what are other questions you'd like to find out?
So the thing he's going to deal with is, even though I seem to have a lot of interest, and that's true, I straight up would not invest in this for a deal. I don't do a lot of angel investing. But the second reason is I don't like that sort of arrangement. That doesn't mean that startups in that arrangement are a bad idea. And in fact, his could be a great idea. And there are startups that have succeeded that have an operating company and several funds. But he will constantly meet people who are intellectually curious about his idea, but who will never get over the complexity when they're by themselves or with their teams, when they're not in front of him. And so he will constantly, first of all, have to deal with that challenge of, how do I persuade them in a way where they continue to be persuaded when they're not next to me hearing my voice, and they need to deal with, okay, will this work? And do I understand all the mechanics of this and the risk of this? So that's like the first portion of it. Now, let's say, though, I've done maybe one or two of these deals before, or I'm, so interested in Proptech that I decide I do want to, kind of interrogate. Either he will be ready with, or I will ask for, or we will get to a point in the conversation where I ask for his financial models. Because the thing that all these sorts of companies have to do is they need to have really, really robust financial models. A lot of startups, when they make a financial model, it's really simple, right? You're basically mapping, like, here's my unit economics of my business, of the SaaS seat I'm selling and how much it costs, and I'm just going to project some stuff, or I might project some stuff around cost. But when you have special purpose vehicles that are going to go get other types of investors to invest in a fund, then the fund invests in some asset in a more traditional basis, you need to actually put that in a more traditional financial services model and say, hey, this fund, and not only do you need to do that for me, you need to do that to go raise that other money. So he needs to go to family offices, he needs to go to real estate investment firms, and he needs to get other people to say yes to the idea that his fund will give them cash, because it gives them cash on a different schedule. So I don't know his business, and it's different per one of these businesses, but as an example, again, his operating company might come to an angel like me for a $50,000 check for some percentage of the operating company. But the fund portion of his business that makes the real estate deals, that fund is going to go to a family office a rich person and say, hey, I will pay you a coupon of some percentage a month or some percentage on some time horizon, and you can compare this to other investment vehicles like debt, or it might be in the structure of debt, and you're going to get a consistent return. So he has to be prepared for that conversation. And again, if I was interested, if I was that sort of investor, the next step would be to ask him for that model, which I'd interrogate on my own. And then I'd come back to him with questions. Our second or third meeting, unlike a traditional fund startup. And when I say fund startup, I mean that doesn't have a financial model that's so important. A lot of that meeting is going to be, let's talk about this this spreadsheet.